Hey guys, welcome back to my channel, and today we're going to go over, is it possible to invest in real estate in your 20s? Now, when we're standing in front of a historic house, we purchased about 15 months ago for about $300,000, invested $250,000 in the reno, $100,000 in carrying costs and closing costs, and we netted roughly $200,000 to $250,000 in profit. I'm going to go over some ways where you guys can get into real estate, and I'll be showing your properties along the way. So you might think, I'm in my 20s, how can I buy a rental property? You might have a bunch of student debt, you might be still living at home with your parents, and you don't know anything about real estate. But with the right education and the right mentors, you can easily grow a great portfolio. It was really tough, but I was able to buy my first property at 19, and by the age of 23, owned 23 units. Just focus on taking the first step, educating yourself. And along the way, you'll grow. Eventually you'll get your first rental property. You're not going to be rich, but it's going to be one step forward on setting yourself up with passive income to head in the direction of financial freedom. So what are the different types of real estate you can invest in? There's the most common that everybody knows about, which is 1 to 4 family residential. Those are condos, townhouses, single family homes, duplex, triplex, quadplex. In addition, there's commercial, which is small plazas, large plazas with big box anchor tenants. We have malls, you have banks, gas stations, Starbucks. Starbucks doesn't actually own any of their buildings, if you didn't know that. And you can go into industrial, which is warehouses and storage units, airports, lots of options. Actually, golf courses as well. I don't know if you know this, but people own golf courses and make money off of renting out their memberships. So there's lots of options for real estate investing. Now, when I was getting started and really excited and wanted to get in, my dad really was resistant and telling me, don't buy any rental property, don't buy any houses, buy commercial. And I was telling him like that, I can't afford commercial property. There's a lot of down payment and it's a difficult loan to get. I found it the easiest to go into residential real estate. The loans are very easy to get. There's a lot of government subsidies. That's why we were able to get the lower interest rates and lower down payments. So the easiest thing and best, in my opinion, is to get a duplex, triplex, or fourplex for your first property. The first loan is usually the easiest. And if you live on one side and rent out the other, it's great the type of cash flow you can build. And if done properly, you can live in one side for free and have the tenant pay all the bills. It's a great way to house hack. And if you pick the location property, and I'm big on location more than I am on the type of real estate asset class. If you pick the right location and it's in residential real estate, possibly you can Airbnb it and their revenue can go through the roof. Hey, so welcome to one of my Airbnbs. So why should you invest in real estate? There's pros and cons to real estate, so let's go over some of them. Pro 1, cash flow. Cash flow is usually what people are looking for when they invest in real estate. It gives you the opportunity to quit your job, retire early, help your family in times of need, retire your parents early. Now, when I was 19, I started buying rental properties and my goal was to replace the income I was making from my job. By the age of 23, I owned 23 units and had a very simple goal. Just make $100 a month from each door. By that time, when I was 23, I was making $2,300 a month, which was equal to what I was making at my job. Now, it might not sound like a lot of money, but that doesn't really matter. It's not about how much money you make, it's about how much freedom you're buying. Pro 2, stability. Even though real estate can have ups and downs in certain sectors, overall, the demand for real estate is always gonna be there. We need places to live, we need places to work, we need places to shop. Now, Amazon is taking on a lot of these businesses, but it's mostly affecting the malls. The local mom and pop shop, small plazas are still here to stay and is a great asset class when you have a diversified portfolio of real estate. So what gives real estate the stability is its functionality. You can buy a single family home in a great area and you can repurpose it to office. You can repurpose it to another use, and not always do you even have to do it yourself. Someone else can come and offer you a significant amount of money because they want to put that there because they find it desirable to be in that location. Unlike a stock, you can't repurpose that stock. You can't make the company repurpose that stock. So in the sense of changing their business model. With real estate, if you buy the right location, you have that stability, you have the functionality of changing and keeping up with the times. So one of the things that I love about real estate is its tax benefits. When you purchase a property, you can get tax deductions. Your mortgage interest is deductible, all the utility expenses, the taxes you're paying on the property. Every time you fix the property, it's deductible. There's a ton of options for you to get write-offs by owning the rental property. Consult your tax professional on ways where you can use real estate to save you money on your taxes, and feel free to contact my accounting firm. We would love to help you with your tax situation. Now, historically, real estate has been a great hedge against inflation. As demand increases, as pricing increases, people will demand high quality real estate. Once people make more money, as inflation increases, people want to be able to spend their money on their standard of living. So as you see today, real estate prices in prime locations are going through the roof. And as the dollar falls, real estate prices rise. Hey guys, we're back in the studio, and now we're gonna go over the next pro, which is leverage. Now you can get leverage in multiple different asset classes, and I'm gonna compare the two common asset classes that are being compared. So we're gonna talk about leverage on the S&P 500 and the returns associated from 1926 to 2018, and home appreciation in California over the last 40 years. So you can see that S&P 500 averaged 10.5% from 1926 to 2018. If you invested $10,000 in over the last 10 years, the return would be $27,140 if you paid cash. But to make it a like comparison, we're gonna associate leverage as well to your account. So if you had a 50% leverage, you would be able to get 20K, and then your return would be $54,281 over the 10-year period. You pay back the loan, you're left with $44,000. Your initial investment, you remove that, your $34,281 is your return, which is really good. The reason I don't really like leveraged accounts, because if the market tanks, you can have a margin call, so you have to put in the additional money. If there's interest on your account, you would have to pay that out of pocket if you don't have enough dividends coming in to cover the interest expense. So those are things to kind of keep in mind, or they can just sell some of the shares to pay the interest expense that's due. A lot of different options out there, but those things are kind of concerns of mine, so that's why I don't like leverage for long term. So a California home, the average over 40 years has been 6.77%. If you invested $10,000 with a 3.5% down, you would get $28,714. So this is $285,000 house. Loan would be $275,000. If at a 5% interest rate, we're gonna consider it higher. In a 10-year period, the appreciation will bring it to $550,000. Loan is $224,000, remaining is $325,000. You remove your initial investment, you made $315,000. Why I like real estate debt is real estate debt obviously is deductible if it's an investment property, but in this scenario, it's a primary residence. Real estate debt isn't on like a margin where you can have a margin call and you have to come up with all the money right away. If for some reason you have a bad year and the housing prices tank, your loan isn't due. It continues. It's 30 years fixed. It has those benefits. The other benefit is when you sell your primary residence as a single individual, federally, there's no income tax on $250,000. And if you're a married couple, there's no income tax on $500,000. So there is these other benefits. So after-tax return in the real estate world is really good. Now, if you lower it to a lower return for a different part of the country, obviously the appreciation would reduce, but still overall, you would have a very good return. If you increase the down payment, same situation, your return still would be very good. And the cost for that loan, you would have to pay for it. The cost of this loan, you're really trading it for the price you would pay for your rent. So if you do it properly, this can work out for you very well, and you can have a really good return. And if you're wondering, is this real? I can tell you, yes, it is real, because I've done this myself multiple times, and that's how I was able to go from nothing to where I am today. And that's literally just keep doing this process. And if you buy the right property, you can be very successful.
What is a margin call?
So a margin call is where the stock market drops and your investment, say if you have a 20K investment, say that drops to 15K or 10K, something crazy happens. Even though maybe the next day it bounces right back, during that day, when it drops that hard, they can call you and say, you have to give us more money because you don't have enough money in your account. And your loan to value is too out of whack. If you don't have the cash, they will sell it. And that means they'll sell it and take what they can. They could sell this $20,000 worth of stock for 10, pay off the loan, and you have nothing left. That same thing happened to Bitcoin investors when they bought their coins on margin as well. They were too aggressive. So with real estate, you don't have a margin call if you get a 30-year mortgage. If you make your payments, the value of the property, if it drops, will not affect your standing with the lender. What they're concerned about is, are you making the payments? One of the cons of owning real estate is the lack of liquidity. When you own a piece of property, it's great, cash flow is great, but if you try to sell the property because you need a chunk of money, it takes usually 30 days to have a sale complete, sometimes longer in bad markets. So it's always important to have cash on the side. As you guys have heard me said many times before, it is really important to do a cash out refi, pull out the equity, have your cash on the side, and use debt to own your real estate. No one ever loses property because they don't have enough equity. They normally lose a property because they don't have enough liquidity to make payments and cover repairs. So it's important. Have liquidity, do a cash out refi, keep your reserves on the side, and be prepared for a rainy day. This con of owning real estate, the lack of liquidity, is actually a pro for me, because when there's a liquidity crunch and people do not have the money, if you do have the money when other people don't, you can get great deals. So the cons with real estate can actually be pros for seasoned investors. So another con to real estate is unexpected problems. We've had electrical problems, we had roof leaks, we've had toilets, we've had tenants flush stuff down the toilet that they shouldn't have. So with real estate, it's really important to have good people on your team. When you're buying a property, review it so you can understand the issues that can come from the property. You have different issues in a 1920s home than you would do in a 50s home compared to a 70s home. So do your due diligence, get the right people on your team, and you can be prepared for those unexpected problems. So another con to being in real estate is tenants. So unfortunately, you have to deal with tenants in this business. And if you don't pick the right tenant, it can be a big con. Tenants are taking care of this valuable asset for you. You wanna make sure that you pick the right ones, because if you don't pick the right one, I've had a few times people maliciously destroy the unit, but most of the time, if the unit did get damaged, it was because of either ignorance or carelessness. So you have to be conscious. Now you can always think, I'm gonna make them pay for it if they break it, but the reality is they usually don't have the money. So if you pick the wrong tenant, there really isn't gonna be an ability for you to get back what you lost. So I went over some pros and cons with real estate, some major concerns that people will have. When I started, I went and listened to the optimistic people, the ones who were excited. That got me really into the idea of getting into real estate. And I took all those pros and I found ways to work on them and to expand on them. And then I have other people in my life that were negative. My father's very conservative, so he would be very pessimistic. And I sometimes would ignore, but after a while, you get maturity and you start listening. So I decided, okay, I'm gonna listen to all of these cons, and what I'm gonna do is I'm gonna prepare to reduce the probability of them happening. I took the pros and increased probability, and I took the cons and reduced the probability. And from that spread is how you make money. Invest in the front end, save in the back end, make a lot of money. So guys, thanks for watching. And the next video we're gonna be putting out is how you can make money in real estate and some tips and tricks. Remember, if you invest in the front end and know your business, study your market, you will make a lot of money. I'll see you next time.